Good afternoon, and thanks for joining us for today's webinar, Tax Planning Strategies for Affordable Housing Developers. I'm Elizabeth Harriger, Partner and Director of Affordable Housing Services at McKonly Asbury. McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you've joined us on past webinars, we're glad that you're joining us again. If this is your first webinar with us, welcome. Over the summer, we hosted a three-part affordable housing webinar series, and if you were unable to join us for those webinars live, we hope that you will view them on our website. McKonly Asbury has been specializing in affordable housing since the late 1980s, and we provide a variety of accounting services to the industry, such as annual audit and tax return preparation, 10% tests, 50% tests, development cost certifications, agreed upon procedures, and a variety of low-income housing tax credit consulting. We also provide property compliance consulting services through our affiliated company, M&A Compliance Management. M&A Compliance Management, which we also refer to as MLCM, provides services such as tenant file reviews, including acquisition rehab lease-ups, assistance with preparing for HUD Section 8 MORs, assistance with correcting non-compliance issues with state and federal programs, assistance in completing annual rent summaries for your state's housing finance agency, and many more services. You can learn more about us at all of these services by visiting our website as noted on the bottom of the slide. We'd love to talk to you about how we can help you or how we can work with your organization, so feel free to contact us. Our contact information is at the end of the presentation, and you can also find it on our website. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you who are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 4 polling questions throughout the presentation. You'll need to answer all 4 of those questions to qualify for the CPE. You will receive your certificate by email a few weeks after the webinar. So our first polling question is on the screen now. Do you wish to receive CPE for attending today's webinar? If you want to get CPE for today's webinar, you'll need to answer this question, yes, obviously, and then you will need to answer the next 3 questions as well. So it looks like most people are looking for CPE, but there's a good number of people in the audience who are just here to learn some new tax guidance today. Joining us today is KBKG, a provider of specialty tax studies. We're excited to have them join us today to talk about the Section 45L tax credit, which is getting a lot of attention right now in the affordable housing industry. They'll also talk about the Section 48 investment tax credit and cost seg studies. So I'll turn it over to Aaron to get us started.
Thank you very much, Elizabeth. So before we get into today's presentation, I wanted to introduce the speakers and talk a little bit about the work that KBKG does. So my name is Aaron Massey. I head up the Mid-Atlantic practice for KBKG, based out of Philadelphia. Today we're going to hear from Sumit Sharma, who's going to cover cost segregation. Brandon Val Verde is going to talk about 45L tax credits, and finally Mike Cornell is going to talk about Section 48 ITC solar panel credits. Next slide, please. So KBKG, as Elizabeth mentioned, is a specialty tax consulting firm. We are not a CPA firm in the traditional sense. We do not prepare tax returns or do bookkeeping. We exclusively focus on helping clients around the country identify and utilize tax credits. So today we're going to talk about 3 incentives that are very common and applicable to affordable housing developers and are getting a lot of attention right now. A number of these were changed in the Inflation Reduction Act, and we expect a lot of these to continue to change with the new administration. And we will, of course, keep you all updated as we hear more. Next slide, please. Okay, so with that, I am going to hand the mic over to Sumit.
Thank you, Aaron. Thank you, everybody, for joining us. Thank you, Elizabeth and the McKonly team for having us present. So my name is Sumit Sharma. I'm a principal with KBKG, specifically in the real estate depreciation cost segregation side of the business. I'm a principal here in the Northeast. A little bit about myself and my background. So I am an engineer by education. I studied in New Jersey at Stevens, but kind of wear two hats, right? I've spent most of my professional career in this tax credits and incentive world. So semi-tax professional, semi-engineering, engineering technical professional. I kind of wear two hats. I have a little bit of background in public accounting. Spent about 6-7 years in public accounting, but mainly in this specialty tax credits and incentive space. So cost segregation is one of the most widely used tools in the real estate business. It is exactly as it sounds. The primary goal of a cost segregation is to segregate, is to identify all of the costs that are related to develop or purchase or improve a piece of real estate, a piece of property, whether that be a low-income housing apartment structure, a low-rise apartment structure, a single-family home, an office building, a shopping plaza, any type. It applies to any real estate, and it applies to almost all taxpayers. Taxpayers that own, operate, invest, buy, purchase, build this type of property have a basis in that property, and that basis is recovered through depreciation deductions. Those depreciation deductions offset taxable income. You're offsetting taxable income, you're reducing your tax bill, you're reducing your tax liability, and that check that you're cutting to Uncle Sam. That's essentially the idea of cost segregation. You're looking at those components, you're trying to understand what those components are, what makes up those components, because there's a lot of tax law, court case precedents, regulation guidance that allows us as practitioners and you as taxpayers to say, this building is not just a building, it's actually made up of many components, and certain components can be categorized differently and take advantage of what's called accelerated depreciation class lives. Typically, a structure depreciates over a very long period. Residential rental property depreciates over a 27.5-year period, commercial over a 39-year period. But to the extent that we can identify those components and categorize them in a 7, 5, or 15-year category, those are much faster and are subject to much faster depreciation. So greater depreciation deductions in those earlier years of ownership. All we're doing is front loading, it's timing, it's front loading depreciation into the earlier years of depreciation. And that's the premise of cost seg. That's kind of the mechanics of how a cost seg benefit or a cost seg study works. If you're accelerating and you're just front loading depreciation into the earlier years, typically especially for taxpayers, property owners, investors that have taxable income, offsetting that income and generating tax savings, dollar is worth more today than it's going to be worth over time. And so it's that premise that dollars that I'm saving for you or dollars that you're able to save now are going to be worth more to you than dollars saved over time. Another goal that often kind of gets overlooked, and I think it's worth mentioning, especially for real estate developers, even from the low-income housing side, is that in order to even do the cost seg study, you have to, like I said, identify these components that make up the structure, make up the building. And so there's a value down the road. Yes, not only is the value to identify the components and properly categorize them from a tax perspective, but 5 years, 10 years, 15 years into owning the property, many developers, many property owners incur significant renovation costs, improvement costs. They need to fix the roof. They need to replace windows. They need to incur, I'm not sure if it's a property that they've purchased, and now it's in a state of disrepair. They need to upgrade certain systems, electrical, mechanical, plumbing. So having a value, being able to reference back to the cost seg study in the year that maybe you built the property or purchased the property to know, well, what was the original value of the roof system, plumbing system, elevator systems? So you're able to reference back to that and perhaps maybe take a disposition write-off if you're replacing all the elevators and whatever basis or tax basis was left in that, let's call it the old elevator system or the original basis of the old elevator system, you can take a disposition write-off. And so being able to reference back to this segregation study, this component analysis can pay dividends down the road for developers, investors, and the like. So those are the two sort of basic concepts I like to kind of start out and address as it relates to cost segregation to set the table for folks that may not be familiar with cost segregation. And just on a tangent, I know we have a lot of audience in the low-income housing apartmental side, but these are very flexible types of studies. These have been around for many years. So the law and the regulation and the court precedents that I was mentioning, these are studies that have been used for 20, 25 years, and so this is not new. This is one of the most common tools or studies that any real estate owner is applying to their property. So it almost becomes a compliance issue. It almost becomes second nature, just like doing due diligence and doing financials on a proposed deal. You kind of think about then, well, okay, the part of your tax planning is cost segregation just becomes a second nature and a part of that tax planning and tax compliance and execution. Can we go to the next slide? Oh, we're going to be launching a polling question, actually. So have you had
Yes, polling
go ahead.
question number 2, have you had an investor require a cost segregation study? So just curious for our affordable housing owners and developers, have you had to have a cost segregation study done? Yes, most of the investors I work with require them. Yes, on 1 or 2 deals, or no. So just let us know. I guess another answer here could have been not applicable, but just wondering if anybody in the audience frequently deals with cost seg studies. Yeah, so it seems like half of our audience has cost segs done or is familiar with them. So that's good to know.
Yeah, very interesting, Elizabeth. Yeah, no, I'm glad. I mean, if there are any questions, I in a few minutes or less try to summarize, a cost seg. But if there's any questions or any thoughts, I think people can put that in the chat. Happy to address that for the audience that is less familiar with cost segregation. But on this slide, it really kind of visualizes and brings home what we're trying to do. It's not just an asset. I mean, many of you see it as, well, this is a building, this is an asset that I own. But in our cost seg world, we see it so much more broadly, right? You can see in like a bluish teal color that the cost seg is, like I said, obviously there to identify the short life properties, things that can be accelerated, and that acceleration actually is subject to even special types of rates, bonus depreciation, one of the issues that I'll talk about in a little bit. But there's compounding factors that the cost seg can drive a tremendous amount of deductions and benefits to tax owners. But even as I mentioned, you can see on the right-hand side in the reddish maroon color that breaking out the components, even though you're not accelerating depreciation or getting really any tax savings benefits by identifying what value the roof is, the windows, the doors, because the IRS still sees that as structural 39-year property, or in case of residential, structural 27.5-year residential property. But knowing that value, 10 years down the road, if you incur costs for window repairs, Elizabeth and the McKonly team are able to reference back to that report and say, okay, well, this is the value of those old windows. can we qualify these renovation expenses as a repair and maintenance activity, or do we need to really capitalize these things? So you're able to leverage that. And then you'll even see above in the gray all these other issues, depreciation related issues that are addressed just by doing the cost seg and identifying what these things are, what the cost for these components are. Section 48 property, is there, is there geothermal systems? Are there solar panels? Are there specialty types of lighting systems, or, infrastructure systems like heating and plumbing systems? And so the cost seg really is think of it as almost a precursor that leads into some of those downstream benefits or downstream avenues that a taxpayer can pursue, which folks like Brandon and Mike will be talking about later in today's presentation. So I think this is a good visualization, but we also have a case study on the next slide that kind of outlays, and this was a case study that we actually we updated for the audience specifically for apartment buildings, just to kind of give you a sense of what kind of deductions are we really talking about. This is a 100-unit low-rise garden-style apartment building. What I did is I just used a round $30 million number, but this is a new construction value. So I said, let's say a developer was building this in 2023. So apartments and apartment property in general can be very favorable property types. You heard me mention on a previous slide that cost seg can be applied to a variety of different real estate, whether it's residential rental, commercial, office, warehouses, shopping plazas. I would say apartments are actually one of the property types that are on the high end of the spectrum in terms of the benefits that can be generated, or benefits that can be squeezed out of doing a study, because there's a lot of property and types of carpeting, kitchen cabinetry, countertops, appliances, a lot of the electrical and plumbing infrastructure that is dedicated as a hookup to those appliances. So there's quite a lot of property that can benefit from that 5-7-year personal property classifications I was mentioning. And then additionally outside, especially think of a garden style apartment, the parking lot, the paving, the landscaping, the sidewalks, the playground, there's a lot of infrastructure outside the building that can benefit from that 15-year land improvement classification. Some of the things that we, when we're dealing with low-income housing properties, we have to be considerate of is, are there any funding, special financing from tax-exempt bonds, in order to kind of, extract that. So these are some of the unique issues that a cost segregation a good provider should be addressing in order to really cleanly define what is the depreciable tax basis. Obviously that has to be done in order to understand what is the basis eligible for the credit as well. I mean, these are some of the things that also lead into what is the true basis eligible for cost seg or tax depreciation as well. So there's that commonality. One of the things that that, especially because this is a newly constructed property, that we need to be aware of is there are sometimes land preparation costs, land acquisition costs. So land, the IRS deems is a non-depreciable asset. So those are things that in my example I excluded from the 30 million. Let's say maybe $5 million was the purchase of the land, 30 million was the actual development and construction. And similar to the credit, we're looking at hard and soft cost development. So not only your general contractor, main construction trades, concrete, metal, steel, but also your soft costs as well. Those are captured. And in this example, a reclassification of around maybe 20-25% of the basis, 5.7 million of 5-year property, $2.7 million of that 15-year land improvement property. You can see about $6.8 million of additional deductions. That's additional. That means if you did not do a cost seg, you would just take straight line standard depreciation over that 27.5-year period, versus if you did do cost seg, you'd get an additional $6.8 million of deductions in the first year. Tax affect that using a corporate tax rate of about 21%. You get cash tax savings of about $1.5 million. So these can be very impactful. I'll address bonus depreciation and sort of why cost segs have become so prevalent in the low-income housing space on the next slide, but or on some following slides. But I wanted to kind of talk about and round out cost segregation as this is almost a tax part of your tax planning tool. You heard me mention it before, that it becomes almost a part of your process with your tax advisors and your CPAs. They can be done, as I said, they were very flexible. The laws do allow taxpayers to look back, not to get too heavy into the tax technical weeds, but you can do an automatic accounting method change. So, are these always done in the initial year that a property, an apartment building is purchased or apartment building is constructed? I would say more often than not, yes. And I'll address it soon about bonus, but there are reasons why, where some developers, even investors, as you guys are thinking about this, you're trying to manage your loss, your loss life cycle, and you're thinking about the years one, not just year one, but the years 1 through 10, and how you're managing those credits and incentives and those losses. So there are sometimes incentives for certain real estate owners to pursue the cost seg analysis in a future year when it can be more impactful to their tax savings and their tax situation. And the laws do allow the owners and the real estate owners to do the study in a future year without amending the returns in the prior years, and be able to apply it in that current year. So in that previous example, constructed in 2023, cost seg study can be done on the 2025 tax year and implemented against 2025 income via a 3115. So there are flexibilities there in considering cost segregation. On the next slide, I do have some other considerations that fall within the purview of cost segregation, and really should be considered. I think they are related to any real estate owner, but also applicable in the low income housing space. Unused deductions can carry forward. There is a carry forward loss limitation. If there's an intention to be selling the property in the near future, then, as I mentioned before, cost seg really is a timing issue. So if you're not going to be having enough time in the property to take advantage of this accelerated depreciation, you would be subject to depreciation recapture, and that would work against some of the benefit of taking these accelerated deductions. So that is something to be considered. I mentioned already the 3115. In the real estate space, you have some investors that are passive, and those passive activity rules can also be a limiting factor to pursuing the cost seg. It's just some of the things that you have to be realistic about in the conversation, that passive deductions are going to be offset against passive income. And so, does this cost seg study, is it truly viable? So these are just some of the things that we like to talk about as they relate to cost seg study and the sphere of the low income housing space. But one of the things that I will mention is, why are they so applicable now? And I think you heard me mention before, is managing those losses and understanding what those losses are as you guys are looking to, bring investors on, maybe in year 1, maybe in year 2, year 3, year 4, I'm not sure, but understanding what that loss picture looks like and thinking about cost segregation early in either your development, or if you've purchased a property and then you plan to do significant rehab, the earlier you think about cost segregation, the earlier you can then, as with any of these studies, what people like Aaron and I always do is we do complementary feasibility analysis, which will map out what depreciation would look like in a cost seg scenario. And we do that for free. We're happy to prepare that. So you can even use that as part of your planning tool in these, in investor and financing, and part of your life cycle planning is that, how can we use these deductions? How can we use these losses? How can we manage this? And I think that any really developer investor would want to do that early than later or after the fact. So finally, I mentioned bonus several times on the last slide. I just want to conclude about this. This was another factor that drove a lot of benefit and why I think cost segs were utilized a lot in the low-income housing space. So post-tax reform, that's the original Donald Trump's tax reform back in 2017, bonus rates were increased to 100%. So a lot of those short life or that accelerated depreciation, personal property stuff I was talking about, the 5, the 7, the 15, is also subject to bonus depreciation. So that drove a lot of deductions, a lot of benefit into the earlier years. Bonus is phasing out, however, it still exists. So bonus rates for 2023 were 80% for property purchased and built in 2026. I'm sorry, in 2024 is 60%, and they're continuing to phase out. So next year it's going to be 40%, but who knows? We may have some tax reform and that may be revitalized. But I think the fact that bonus applies, and what happened also in 2017 was that bonus applies to acquired property, so used property. Those were two really additive factors that really drove a lot of benefits to the low-income housing real estate developers, the ones that were not only building but that were buying and rehabbing. So just things to consider. I mentioned why you would want to consider sooner rather than later. I'm not sure, Elizabeth. I wasn't able to track if there was any questions in the box. But
I did not see any questions come in.
But I thank you for your time, and I'll hand that over to now Brandon, who'll talk about some of the 45L credit incentives.
Can I just pop in there on the cost seg discussion for a minute? I thought it was interesting, your point about how it breaks out the different 27.5-year bucket items into smaller buckets so that in the event there's a disposal or something down the road that helps with the depreciation reporting for our clients and for developers. I thought that was interesting. And my question is, when is the ideal time to do this? I know you said you could do it earlier rather than later, which that makes sense to me. We sometimes see clients having it done, and now the investors are driving this for our clients, but
of course
they'll do it as I guess as a planning tool, and then when it comes time to do the tax return, they give us this cost seg study that doesn't tie into the costs that actually were incurred. Do you see a lot where investors would have do something preliminarily so they know when they're projecting what their depreciation is going to look like, and then do you go back in and true it up?
So great point, Elizabeth, and the answer is yes. So to your point, the earlier you're having those conversations, that the expectation is that we're doing a $10 million rehab project, and so you're planning for those losses and those deductions associated with that. But we all know construction sort of evolves, and maybe that turns into a $5 million rehab project. Maybe that turns into a $25 million rehab project. So there's a lot of things that if the earlier you can plan for when those sort of phases are occurring, you can then also plan that, okay, we have a preliminary estimate and we know what sort of caveats we're baking into this preliminary estimate. We know that we should revisit this estimate once we have a finalized construction budget. We know that we should have probably a check-in with the cost seg team midway through, because now there's been scope creep and now the scope is ballooned. So what does it look like? You can start to plan for some of those iterations so that you're not blindsided at the end of the day when when construction's complete. So I think being thoughtful about that is a big step, and knowing when to have those, call it checkpoints, is going to be that much smarter, and that requires some collaboration between CPA, developer, investor, and cost seg practitioner.
Thank you. I think if we advance to the next slide, we're going to be at another polling question. So before we get started with the next topic, which is going to be Section 45L credits, our polling question here is, how familiar are you with Section 45L credits? Your choices are: I've incorporated them into at least one deal, I'm incorporating them into my current deal for the first time, I've heard of them, but I'm unsure how to use them, and your last choice is, I'm intending to learn more about them for the first time. So remember, if you want to get CPE credit, you need to select an answer here. You answer the polling question. And even if you don't need CPE credit, it would be interesting to know just where our audience is at with their knowledge of this topic. Okay, so it looks like this is relatively new to most people here in the webinar today. So with that, I'll turn it back over to KBKG.
Thanks, Liz. This is Brandon Val Verde. So 45L, the Inflation Reduction Act, when it was introduced, created two eras of 45L, a pre and a post era, IRA era of 45L, each with its own unique guidelines. And what determines the era in which the credits fall is move-in dates. So initial move-in dates. So post-construction move-in dates, and these are for, leased units and sold units. Okay, so what I'm going to do is cover the pre-IRA era of 45L here on these first two slides, and then dedicate the rest of the presentation to the post-IRA era that starts 2023 and forward. All right, so starting with a little background on 45L. So 45L was first introduced in 2006 as part of the 2005 Energy Policy Act as a tax extender. So meaning it's temporary in nature, and it was extended numerous times throughout its inception, and up until its last extension brought on by the Inflation Reduction Act, it had actually sunset at the end of 2021. So what the Inflation Reduction Act did is extend 45L retroactively for 2022, as is under the historical guidelines, where the credit amount is $2,000 per unit. And so if you have a 100-unit development, you're eligible for up to $200,000 in tax credits. Again, this is 21 through 2022 move-ins, historical guidelines. Those historical guidelines involve outperforming an outdated code, the 2006 IECC, modified to isolate your heating and cooling systems and your building envelope. So no lighting, no domestic hot water, just your heating and cooling system and your building envelope. And if you have a good envelope, what happens is your heating and cooling system doesn't have to work as hard. And your building envelope is essentially your walls, your floor, your roof, everything that separates the inside of your home from the outside. And because this is such an outdated code, what we're finding throughout the years is that sometimes building to your local code requirements could result in tax credits. In California, for example, we have a pretty strict energy code. And so we typically see 100% or close to 100% qualification in most cases. So $2,000 per unit, and this applies to single family and dwelling units located within low-rise residential buildings, 3 stories or less. And this also includes significant rehab and reconstruction projects. And where we typically see success with those is where developers have replaced at a minimum windows and heating and cooling equipment. So if we're just replacing the roof, for example, that wouldn't move the needle enough to result in tax credits. Next slide, please. So eligible taxpayers include home builders, multifamily developers, and this also includes investors and investor groups who fund the development and either construct the development themselves or hire a third party to construct the development for them. So for affordable housing developers, what this means is monetizing the credits through your investors, just like with the Section 42 credits. However, what's required, since this is a reactive study here, we're talking about going back and capturing these credits retroactively. So 21 and 2022 tax years are still on the table, but what's required is investor appetite, identifying that investor appetite and then amending partnership agreements. And then because 45L reduces basis in this era for calculating your LIHTC credits, viable properties must have excess basis. So it's still possible to go back and claim these credits retroactively for affordable housing developers. It's just that there's a few more hurdles. And what's required is a third-party certification by a qualified professional like a KBKG. In that study, what's involved is energy simulation modeling to show that performance outperforming that outdated code, that 2006 IACC, and then post-construction field inspection. So obviously this is post-construction because these developments are already in place, but if the building's changed hands, for example, what's required is access. So if access isn't available, it may be challenging to go back and claim these credits. Next slide, please. Okay, so this is the new era of 45L that now applies to move-ins that took place 2023 and going forward. So what the Inflation Reduction Act did is not only extend it retroactively for 2022, but also extend 45L through to the end of 32 under new guidelines. Now this is, like I said, 45L is still a tax extender, but this is the longest extension that we've seen in 45L's history. Before it was maybe 1 or 2 years, maybe 2 years, retroactive and maybe 1 year forward. So it was very difficult for developers to plan for. And we would get questions like, what's it going to take? What's the energy efficiency criteria for my next development? I have a development under construction. How do I ensure that I get these 45L credits on this next property? Thanks for these credits, but what do I do going forward? And it was always very challenging to provide any sort of guidance because, it was always very challenging to know whether or not 45L would be extended, one, and then two, if it was extended, there was always a chance that the guidance could change. So now what we see is a long runway for developers to plan and a list of specific energy efficiency criteria for them to follow. Okay, so the same eligible taxpayers that we saw previously, except that now for affordable housing developers, since this is more of a proactive study, there's no need to amend partnership agreements, right? We're incorporating these tax credits into the deal from the beginning as opposed to on the back end, which was what was required in the past. Okay, so there's new energy efficiency criteria, and that energy efficiency criteria involves certifying under certain energy efficiency programs. This table here lists 2 energy efficiency programs and the tax credits associated with them. So the tax credits are still on a per unit basis, but they're no longer $2,000 across the board. It now varies depending on your unit type, your building type. At the first level, let's call it level 1, the Energy Star level, where the credit ranges from $500 per unit to $2,500 per unit. Single family home developers, their credit starts at $2,500, but for multifamily developers, there's a base rate. And if prevailing wages are paid, that base rate is increased 5 times. So then it becomes $2,500 per unit. At the next level, the ZERH or Zero Energy Ready Home level, that's the name of the certification program. And as what it stands for is Zero Energy Ready Home. So there's a readiness component built into this, meaning there's a need to be future ready, and there's an indoor air quality component built in. And I'll go into those specifics on some later slides, but for now, level 1, Energy Star, level 2, ZERH. And again, that base rate starts at $1,000 for multifamily, and then $5,000 for single family, and then can increase 5 times for multifamily developers if prevailing wages are paid. So there's no prevailing wage safe harbor like there is with 179D. And then there's also no apprenticeship requirements like there are for 179D and some of the other IRC credits or IRA credits. Next slide, please. So what are prevailing wages? So prevailing wages are a minimum pay requirement for workers on a job based on what they do, what they're doing, where the project's located, and when it comes to residential, the number of stories, okay? And then what types of multifamily developers pay prevailing wage? So prevailing, so developers that utilize HUD financing, HUD D4 loans, HUD home funds, market rate developers can utilize these loan products, but what we see in most cases, affordable housing developers utilizing these loan products that require prevailing wages as a condition of the funding that they receive. Okay. Sometimes there's state-specific laws, like in California, we have a SB 6 law that removes certain zoning requirements if prevailing wages are paid. In the Pacific Northwest, if Section 8 vouchers are utilized, prevailing wages are required. Union projects pay prevailing wage. And then, as we saw during the lockdown a few years ago, sometimes just to attract skilled labor in certain states, developers had to pay prevailing wages. Next slide, please. Some other key changes. So the story height limitation's been removed. So before 45L was limited to low-rise residential construction, but now mid-rise, high-rise, and dwelling units located within mixed-use developments that are at least residential, 50% residential, are now eligible. So for the first time, we're seeing some interplay with 179D, which is another incentive. And then when it comes to rehabilitation projects, there's a big change where now going forward, rehabilitations are now limited to full gut rehabs only. And then for affordable housing developers, 45L no longer reduces basis for calculating LIHTC credits. So developers are no longer limiting their viable candidates to just those with excess basis. Now, just about every affordable housing development is a good candidate for 45L. So this is a big boost for affordable housing developers, not only because they pay prevailing wage, but because most are built with energy efficiency in mind, and most are also participating in other similar programs to Energy Star and ZRH, like NGBS and LEED, where there may be some similar requirements and some overlap. And all it takes is maybe identifying those few check boxes where some additional requirements may apply. Next slide, please. So what's required from an energy efficiency standpoint? So at the first level, level 1 or Energy Star level, the $500 to $2,500 level, what's required is a mix of construction-related requirements and energy efficiency measures that are typically identified via energy simulation modeling. These are more dynamic, measures that are identified that apply to your HVAC system, your hot water system, maybe your appliances, and the trick is identifying the right mix of cost-effective measures to meet the energy efficiency requirements tied to the certification. And then the construction-related requirements, and these are by no means an all-encompassing list of requirements. This is just a high-level overview of some of the construction-related requirements, but these are more universal in nature and apply to more projects. There's more to all projects. There are some nuances when it comes to project location and maybe the number of stories, but for the most part, they are pretty universal. And then at this level, this $500 to $2,500 level, what's also required are third-party inspections and verifications throughout construction. Okay, so because of this, there's really, unfortunately, no path to go back and claim credits retroactively for projects that have already been completed and leased up. Let's say, like 2020, move-ins that happened in 2023 or 2024, and possibly even 2025. If these inspections and verifications weren't performed, there's really no way to go back and claim these credits retroactively. So it's not a statute of limitations issue. It's a verification and inspection issue. And so a lot of pre-construction planning is involved. You don't just happen into meeting these requirements. It takes some significant planning. So it's not like the old era of 45L where you just building to the local energy code requirements and that resulted in tax credits. You don't see that under this new era of 45L. Next slide, please. So at the next level, the level 2 or the ZERH level, what's required is everything that's required at the Energy Star level. So it's important to point out here that Energy Star is a prerequisite for this Zero Energy Ready Home certification. So everything that's required at level 1, and then additional construction related and energy efficiency measures on top of those. And then this readiness component, this future readiness component where there's solar readiness and heat pump water heating readiness and EV charging readiness. So not necessarily the components themselves or the items themselves, but instead the provisions to add those items in the future. So the conduit, the space on your electrical panel, that kind of thing. And then there's an indoor air quality component mixed in. So low VOC paint, low VOC floor coverings, low VOC cabinetry, that kind of thing. So, and then again, the verifications and inspections that mirror those under the other level, the Energy Star level. And I would say, just generally speaking, that at this level, there's even more pre-construction planning than at the previous level, just because of these future readiness and indoor air quality components. Next slide, please. So what do I do? Where do I go from here? So the key is to be proactive. So tax preparers, reach out to your developer clients. Developers, reach out to your tax preparers. Share your pipeline with them. Let them know which projects you have coming up. And set up a call with a third-party verifier like KBKG to get started early. Because if we're waiting until tax returns are due to take advantage of these tax credits, credits will be lost. So it's not like we can go back. So got to be proactive. Okay. So next slide. And this is just a summary of the changes. So Liz, I mean, if you have any questions.
I do.
Yeah.
So if, I guess, is there a minimum unit count size that affordable housing developers should be considering? I mean, obviously, the more units, I would think the more tax credits you're going to get, but is there a minimum size that makes sense?
I would say somewhere around the 20 unit mark is where it makes sense, but it really comes down to the value of the credit identified, and if prevailing wages are paid, obviously that unit count is going to be lower than if prevailing wages aren't paid. So yeah, about 20 units, I would say. Okay.
And I've heard recently that the low-income housing tax credit investors do have an appetite for these credits, and that you're almost leaving money on the table if you don't go after them. Yeah. So in Pennsylvania, there is a tax credit funding round in February where our developer clients are working on their applications for that competitive round now. What would they need to do now to consider this for a deal that they're putting together to go in February, or is it too late? Is this something that they would maybe want to consider for their next deal?
Well, I would say that the earlier the better. So even if it's in the planning phase, typically when we get involved is during the permitting, when maybe it's at 20% or 80% DD, depending on which version of 45L, which credit level you're going after. But we don't typically get involved in the funding level. Typically a syndicator is already identified and investors already in place once we get involved. But I think generally speaking, because 45L tax credits can now they're now it's more of a proactive study than a reactive study. Building those conditions, building the credits into the tax credit deal from the start gives you more flexibility in terms of monetizing the credits. You have just more options. I'll leave it at that.
Okay. That makes sense. Thank you.
All right, happy to help.
Okay, we are going to talk very briefly about the investment tax credit around the Inflation Reduction Act and energy efficiency credits. This is Mike Cornell with KBKG, and we'll just, we've only got a few minutes, so we'll just start by saying that with the Inflation Reduction Act, that is something that the Biden administration was very keen on doing to incentivize a wide range of organizations to accelerate, their initiative for clean energy adoption. There's been a lot of talk on whether or not the Trump administration will basically reverse this. So a lot of this is up in the air. So we'll go over it. We'll talk about a couple of things, but know that at some point next year, all of this could become moot. So, but one of the things with the that the Inflation Reduction Act did was create a tax credit for energy efficiency, energy efficient construction, specifically with energy production. So think solar panels on the roof or wind facilities. And it allows you to take a credit, not a deduction, but a credit against your taxes. And it also created these two code sections, 6417 and 6418. And 6417 allows a tax exempt organization to get a direct payment. So they cannot use a credit, but they could get a direct payment for their energy efficiency property. Or you've got 6418, which allows certain eligible taxpayers to choose to transfer or sell a portion of their eligible credits to an unrelated taxpayer for cash payments. So this is great because if you need tax credits, you can do this. If you're tax exempt and you don't need tax credits, you can get a direct payment. Or if you're a taxpayer but you don't really have enough income to be able to utilize, you don't have enough tax owed to utilize this, you can sell your credit to somebody else. So let's go to the next slide. And you'll see here, these are kind of a lot of the energy credits that are in play. We really only see the ones that are kind of highlighted here. And for purposes of this discussion with the low income housing, we'll really only talk about the Section 48 ITC credits, and that's for solar or wind projects. So let's go to the next slide. Again, this is for the transferability of the credits. And hang on here, trying to summarize. So in simple example, let's just say you have a $1 million solar project. So you're building or you've acquired a low income housing project and you're adding solar panels to the roof, and you spend $1 million on those solar panels. Typically, probably at least 900,000 of that's going to qualify as eligible cost basis for this credit. There are rules around what does and doesn't qualify, especially if you're adding it to an existing building and you've got to do some structural modifications to the roof. But so let's just say you've got 900,000 of that cost is going to qualify. Of that 900,000 basis, the base credit is typically 30%. And there are some adders that can add up to an additional 40% of that qualifying basis as eligible for the credit. And so let's go to the next slide. And so I mentioned that there are some adders that can increase the percentage of the basis. That the base credit is 30%. You've got these three adders that come along. One is a 10% energy community bonus. Another is a 10% domestic content bonus. And then there's a up to 20% low income community bonus that might get added on to your 30% base credit. And each of these has specific eligibility requirements. And the nice thing about them is they're not treated any differently from the base credit in terms of either being able to get direct payment or transferability. So if we go to the next slide, so let's just focus on that low income communities adder. It increases the amount of the energy investment tax credit for the eligible solar and wind facilities based on these, as long as it satisfies one of these four categories. It's either built in a low income community, which gives an additional 10%, or it's built on Indian land for an additional 10%, or it's part of a qualified affordable housing development on a certain federal housing projects, that's an additional 20%, or it's part of a qualified low-income economic benefit project, serving low-income households for 20%. You have to, so some of the rules, you have to have a facility less than 5 megawatts, and the Department of the Treasury and the IRS have partnered with the Department of Energy to administer this program, and the Department of Energy reviews applications and makes recommendations to the IRS, which will allocate up to, per year, 1.8 gigawatts of eligible solar and wind capacity. So obviously, to get this adder, you have to go through a process, which on the next page. So to claim this community adder, the low income community adder, you've got to follow a specific application process through the Department of Energy's applicant portal. Okay, and the portal is built as a two-step process. Step one is you submit an application for an allocation of capacity for each individual facility. So if you've got multiple facilities that you're working on, you have to do an allocation application for each one of those. You apply the appropriate category and application options, and then those applications are reviewed by the DOE review team, and then it's approved or rejected by the IRS. If it's approved, the applicant will receive an allocation approval notice, and the facility must be placed in service within 4 years of the date the allocation approval notice was issued. Then, after the facility has been placed in service, the applicant will return to the applicant portal to report the date the facility was placed in service, confirm there have been no material ownership or facility changes, and submit their required documentation. So if approved, the applicant is notified that they can claim the energy percentage increase through the applicable tax filing process. Now for 2024, the program application deadline was back in October. It was October 10th, and the 2025 application process has not opened yet. Now, as of now, the Treasury and the IRS anticipate allocating that 1.8 gigawatt capacity for next year, which is also the first year of the Clean Electricity Low Income Communities Bonus Credit Program, which includes more than just solar and wind, if it comes to pass. So we can go to the next slide. There is obviously if you decide you're going to transfer or sell your credits, there is a process behind that that has to be considered. But we won't really get much into that because we're running out of time and we're not 100% sure that it's even going to be around next year. So if we want to go to the next slide, basically how we can help with this process is we assist both the buy and the sell side, but for a developer or owner who's looking to sell their credits or even just kind of figure out what their credits are, we can assist in project qualification and credit calculations. Essentially what we do based on the type of energy technology utilized is we confirm the project actually qualifies for the credit, and then we can do all of the cost analysis to determine the eligible basis for the credit computation, and then provide all of that documentation, can help you with the required forms that you need to fill out, and just kind of hold your hand through the process, since it's not something that most people are familiar with. But I see we're out of time. We'll wrap that up, and I'm glad to answer any questions that you might have on that.
If we can go to the next slide, I think we'll be at our final polling question. Is your company, or are you working with a company that is submitting a LIHTC application in PHFA's upcoming funding round? So yes or no? Are you going to be scrambling over the holidays, or we're not having to worry about putting in an application this round? And while we're waiting for that poll, I just want to thank Mike, Brandon, Sumit, and Aaron for joining us today. And thank all of you for joining us for today's webinar. And if you have any further questions, you can feel free to reach out to me or any of our presenters. It looks like our polling question has closed. I didn't see the results there, but oh, there we go. So yeah, we have about a third of our audience is submitting an application. So good luck to everyone. And just final housekeeping, a recording of today's presentation will be posted on our website and social media sites in a few days. And for anyone who requested CPE and answered the polling questions, those certificates will be sent out within the next few weeks. Additional training is our December 19th webinar on income taxes. We'll talk about the evolving landscape regarding taxes as the incoming administration and recent developments shape the future tax policy. So thanks again for joining us, and I hope you have a happy holiday season.